Hello everyone, my name is Frank with Group F, and today we are going to be doing life and health insurance from Chapter 9 and property and liability insurance from Chapter 10. Our group is consisted of Mohamed, Dylan, Bryn, Emily, and myself.
Here's a quick overview of the Chapter 9 sections that we'll be covering today. The need for both life and health insurance comes from Principle 7, protect yourself against major catastrophes, and the main ways to do this is through planning and controlling, by having an insurance policy. Whether you should take out an insurance policy is a risk-return trade-off, and you must decide, are you willing to pay for the policy to cover your risks? Health and life insurance are very important because it protects you from unknown health risks and death. There are a few main reasons that healthcare is so expensive, the first being lack of incentives to economize, medical research being very expensive, and doctors having to pay high premiums. The high cost of insurance can affect you because it may cause providers to lower your coverage amounts or make you cover more out of pocket. If you don't have health insurance, the Affordable Health Care Act helps to give Americans access to more affordable health care. While this is a good option if you can't afford private health care, there are many limitations to coverage, so it's very important to consider healthcare when looking at your financials, and some think that it should be considered something you must have, like food and housing. Insurance is based on risk pooling, and the idea behind this is diversification of individuals pool their financial risks of death when looking at life insurance. The amount of money that you put into the pool is the premium and differs based on your risk of death. You are the policyholder, and a business can also be the policyholder, and if your dependents are the beneficiaries who receive the money after your death. The main reason for having life insurance is that so when you die, your dependents will have money to live off of and be able to survive without you there anymore. Typically, if you don't have any dependents, then getting life insurance is not as important, but if you're at a high risk of serious health problems, then having life insurance could be beneficial. If you're wondering about specific examples of who should consider or buy life insurance, this table from the textbook provides many examples and lays it out very well. When deciding how much life insurance you need, the first step is defining your priorities and goals. Who, what, and how long do you want this life insurance and money to take care of? The second step is figuring out the amount of life insurance needed to meet the goals you've set. There are two ways to calculate this number. They're the earnings multiple approach and the needs approach. It's also important to note that whether you have a higher net worth can mean that you might need less life insurance because you'll have more money to cover expenses for your dependents. The earnings multiple approach is based on wanting to replace the annual income from the death of the breadwinner, and also tells you how big the lump sum should be to replace the stream of income. Some important things to consider about this approach is that it depends entirely on how many years you'll need coverage for and the return that you think you can gain, and it also does not consider what savings you have. Here's an example of how you would find the amount of insurance using earnings multiple approach. So when looking at the information given in the example, step 1 is to adjust the salary in the example to the cost of living for the remaining family members. And then after adjusting the salary, you must find the multiple using the data from the question as well as the given table. And then finally, you should multiply the adjusted income by the earnings multiple factor to get the amount of life insurance that you need. This method considers only your income replacement needs, and you have to remember that insurance needs are going to change over time. So that means your earnings multiple is also going to change over time, and you should redo it every once in a while. And then you can also see here the full equation to solve the example, and also how to solve using a financial calculator. You can simply use a PV function and plug in all of the given info. The second approach is the needs approach to decide how much life insurance you need, and it's more specific and customized to your specific needs. And there are many categories of needs that you must determine for how much money you're going to need in the future. Some examples are the immediate needs at the time of death, debt elimination funds, immediate transitional funds, dependency expenses, spousal life income, educational expenses for children, retirement income, and then typically this is just all added up for the amount that you need.
So the first type of major life insurance is term insurance, which is where the client pays a premium based on the probability of when the client will die. This covers a very specific term, and it's the least expensive form of life insurance. and it has a low premium towards the beginning, with the value increasing as the insured gets older. Now, most of this term insurance is renewable, and upon every renewal, premiums can increase dramatically due to the insured's increasing age and possible declining health. To combat this, there is decreasing term insurance, where the premiums remain constant but the face value of the policy decreases. There's also group term insurance, which allows a specific group to buy a policy. So the other major type of life insurance is cash value insurance, which has two components, a life insurance and a savings plan. Most of the money goes to premiums and the remainder goes to savings. Once the client passes, the savings are then paid to the beneficiary, and it provides a tax advantage. There are three types. The first is whole life insurance, where there's a full payment of policy once the insured passes or reaches a certain age. The next is universal life insurance, which combines term insurance with a tax-deferred savings plan, and premiums and benefits can have more flexibility. These are broken into three parts: term insurance, cash value, and administrative expenses. Next is variable life insurance. This is where the insured takes on the investment risk, and where premiums can be fixed or more flexible, and allows the policyholder to choose investments for the cash value. Fine-tuning your policy. So policies can have different features which make a policy more suitable to an individual. Some of these features could be a contract clause, which are provisions set in the contract. An example of these could be a beneficiary provision, coverage grace period, or a loan clause. Another type is riders, which are special provisions meant to provide additional benefits that can be added to a policy for an additional cost. Some examples of this are accidental death benefit, guaranteed insurability, and the cost of living adjustment rider. And the last option will be settlement and payout options, the various ways a policy may be paid out to the beneficiary. And then other types of this are lump sum settlement, interest-only settlement, and interest payment settlement. When it comes to buying life insurance, selecting a knowledgeable agent is vital. Look for licensed agents or the CLU certification, which is the most rigorous designation for life insurance agents. When it comes to comparing costs, there are two main methods. The first is the traditional net cost method, which is calculated by summing the premiums over a certain period and then subtracting the sum of the dividends. The next is the interest-adjusted net cost method. This considers the time value of money, and it makes it more viable than T&C. When it comes to making a purchase, you have to consider cash value versus term insurance. Term insurance policies can be easier found on the web, where websites can find you different rates. Cash value policies, however, are harder to compare various policies, and you're better suited with an agent who can find the right features for you. Moving on to health insurance, the Affordable Care Act was passed in 2010 under the Obama administration, and it was a major tidal wave in the health insurance industry. Some types of health insurance include basic health insurance, which is a combination of hospital, surgical, and physician expense insurance. Next is the major medical expense. This is meant to cover the costs not covered by basic health insurance. There's also dental and eye insurance. There are two types of plans when it comes to basic health care. The first is a fee-for-service plan, which allows you more freedom when choosing doctors and hospitals and reimburses you for expenses. The next is the managed healthcare plan, where expenses are prepaid and you have a more limited amount of doctors and hospitals available. An HMO involves a flat fee payment that grants access to a set list of medical service, where there may be a copay with each visit. There are three types: the IPA, the group practice plan, and the point of service plan. Some drawbacks to the HMO are long waits, difficult to receive a service outside of the HMO, and in some cases there are small amounts of providers. Another type of health insurance is the PPO, wherein the employer or insurer makes deals with medical providers for their members to receive healthcare at reduced rates. When it comes to group versus individual health insurance, group is usually provided by an employer, where all employers are under the same plan, and individual is usually purchased by the policyholder themselves. When it comes to government-sponsored healthcare plans, there are two categories: state plans and federal plans. Workers' compensation is a state plan that's meant to provide workers with a living wage in case of an incident that qualifies them to receive workers' comp. Medicare is a federal plan meant to provide medical benefits to those with disabilities and are 65 and older, and have various benefits. Other policies include the Medigap policy, which is meant to fill the gaps in a Medicare plan, and Medicaid, which is a joint program between federal and state governments. It's very limited in scope, and payments go towards Medicare premiums, deductibles, and co-payments. When it comes to controlling healthcare costs, the first step is to stay healthy, as well as using medical reimbursement accounts, which there are two types: the flexible spending account and the health saving account. When it comes to transferring jobs and keeping your health insurance, COBRA is a new law that allows those who work at companies with 20 employees or more to be covered after the employee leaves the company for a valid reason. What to look for in a health insurance plan? First, you should see who is covered by the plan. You should see what are the terms of payment and what are your premiums, and are there any exclusions or conditions that may prevent you from taking on this insurance. When it comes to choosing a plan, thanks to the health insurance marketplace, plans are now easier to compare and are divided into 5 tiers: bronze, silver, gold, platinum, and catastrophic.
Now moving on to disability insurance. This is insurance that will provide you with income if you are disabled and unable to work. It's important to have because when your income stops, you still need to be able to afford necessary expenses, and you may have a higher chance of becoming disabled than you think. Some people don't want to purchase this because it's often expensive. The cost is influenced by your occupation, as some jobs put you more at risk of becoming disabled and not being able to perform that job anymore. Besides paying for a private disability insurance plan, you may also be eligible to receive workers' compensation or Social Security coverage. Although most people are covered by workers' comp, be aware that this does vary state by state, and the benefits only apply if your disability is work-related. As for Social Security, your benefits are determined by years in the Social Security system and your salary, and are dependent on you not being able to work any job at all. Now let's take a look at some of the key features when deciding a disability insurance plan. One is how the plan defines disability. This could be not being able to perform your own occupation that you currently have, not being able to perform an occupation for which you're reasonably suited, which can be difficult to define, or a combination of both. It also could be smart to have a plan that will pay partial benefits if you return to work part-time. As for benefit duration, it's best to choose a long-term disability plan, as it makes more sense for protecting against financial catastrophe. There are also other provisions, like the ones listed, that waive premiums when disabled, don't allow the insurance provider to cancel your plan, and even pay for rehabilitation. You should always have enough disability coverage to maintain your current standard of living. When deciding this, take into consideration the earnings your savings and investments produce, as well as you may be able to partially live off that. As an example, say I make $7,000 a month after taxes. If I don't have any Social Security benefits and my employer provides $2,000 in insurance coverage, I'm not a veteran, and I don't have any other disability coverage at the moment, I'll need to purchase $5,000 more a month in coverage. Now moving on to long-term care insurance. This insurance covers nursing home and home health care expenses for when you're elderly and can no longer live on your own. Due to increasing life expectancies and the fact that 65-year-olds today have a 70% chance of needing long-term care, this is crucial insurance to consider having. It pays direct benefits to nursing homes, and premiums do rise with age. It's best to look for these plans when you're young and healthy, taking advantage of discounts offered. This may come as surprising, but Medicare, Medigap, and private health insurers really lack this type of coverage, making it even more necessary to look into plans that specifically cover long-term care. Taking a look at some potential policy provisions and specifically qualifying for benefits, typically policies will provide benefits if you cannot perform at least 2 activities of daily living, like walking, eating, or getting dressed. It's also important to make sure that you're covered in cases of cognitive impairments, especially if you have a family history of that. It's also important to make sure that your type of care is flexible, covering both nursing home and at-home care. Here's a guideline of questions to consider when choosing a plan. Something here that's important to know is the question, is the benefit adjusted for inflation? You want to make sure that your benefit does not become useless due to high inflation. Also, the waiting period mentioned can be thought of as a deductible, and most financial advisors suggest a 20-day waiting period. Any shorter is going to be very expensive, and any longer is more risky. To talk about some behavioral insights associated with health and life insurance, anchoring is a main concern to be aware of. For example, when people are selling life insurance, they may start the suggested coverage at higher than what you need. When purchasing insurance in general, it's important to have an action plan for the course of your life. Here are some guidelines that are easy to follow as you get a job and have kids.
Moving on to Chapter 10, we will talk about how to understand, buy, and maintain your homeowner's insurance policy in a cost-effective way. We also talk about how to protect your property, how to manage your insurance, and how to pick out the right auto insurance and file a claim. There are 6 different standardized package homeowners policies. HO1 and HO2 are named perils insurance. HO3 is open perils insurance. HO4 is for renters. HO6 is for condo owners. And HO8 is for older homes. Moving into the coverage, coverage A is dwelling. This protects the house and any attachments to it. Coverage B is for other structures. This protects other structures on premises that are not attached to the house. For example, your landscaping, a detached garage, or an outhouse. Coverage C is personal property. This protects any personal property owned or used by a policyholder regardless of the location of the property. For example, if someone steals your suitcase on vacation, it is covered up to a certain extent. Coverage D is loss of use. This provides benefit if your home cannot be used because of an insured loss. Section 2, personal liability coverage. Coverage E is personal liability. Coverage F is medical payments to others. This protects policyholders and their family members from financial loss if someone is injured on their property or as a result of their actions. Diving deeper into homeowners insurance policies, first we have HO1, which is the basic form of a named perils insurance. This includes all coverages A through F, and it includes all of the named perils such as fire or lightning, vandalism, riot, volcanic eruption, smoke, and more. HO2 is a more broad form, and it will typically cost you 5 to 10% more because coverage D will cover you for 10% more than HO1, and it includes all of the perils listed in HO1 along with some others such as falling objects, weight of ice, snow, or sleet, and some others. HO3 is an all-risk form. This is an open perils coverage that will cover all of your losses except the ones that are specifically excluded, such as flood, earthquake, war, and nuclear accident. This will typically cost you 10 to 15% more. HO4 is renter's form. It is aimed at renters or tenants and covers personal belongings but does not include liability insurance. This is the only policy that does not include coverage A and B. Its covered perils are the same as HO2 in regards of personal property. HO6 provides personal property and liability insurance for co-op and condo owners. It includes all coverages, and its covered perils are the same as HO2. Moving on to the last one, we have HO8, older homes form. This is designed for older homes, insuring them for repair costs or actual cash value rather than replacement costs. It includes all coverages, and its coverage perils are the same as HO1. Moving on to supplemental coverage. The homeowners policies that we have just mentioned and discussed might not cover you fully. They might have some gaps, therefore you might want to look into some supplemental coverage such as a personal articles floater, which will provide you extended coverage for coverage C, personal property. You might want to also look into earthquake and flood protection if you're in a high risk area. The rates on this coverage will vary depending on the risk area that you are in. Inflation Guard is pretty simple. It protects you against inflation eroding your coverage. And then replacement cost is the coverage provides for actual replacement cost of a stolen or destroyed item as opposed to its actual cash value, which could be significantly less because actual cash value is your replacement cost minus your estimated depreciation. Moving into the co-insurance provision, this requires that you pay a portion of your own losses if you do not purchase what they consider an adequate level of insurance. The 80% rule is that many companies requires you to purchase insurance to cover at least 80% of your home's full replacement cost. Otherwise, you might not be eligible for the replacement cost coverage. Your insurance credit score is what helps determine what your home and auto insurance rates will be. The lower your insurance credit score, the higher your homeowner's insurance rate will be, and vice versa. The insurance credit score is calculated similar to your original credit score, except the weightings are a little bit different. Payment history will have a greater weight, while types of credit used will have a lesser weight. How to improve your credit score. First, you want to pay your bills on time. Second, you want to pay down your debt. 3, do not cancel any long-term accounts. 4, do not add more credit cards hoping to increase borrowing capacity. And 5, make sure that your financial life is in order. For our first discounts, we have high deductible discount. Deductibles are the amount you agree to pay before insurance coverage kicks in. So the larger the deductible, the less you pay for insurance coverage. Insurance companies will typically require you to pay $250, but if you decide to pay a higher amount, you can save a higher percentage. If you install security and smoke detector systems, you can often be eligible for a discount of 2 to 5%. If you have more than one policy with the insurance companies, they will sometimes grant you discounts for this. And if you decide to pay in one annual lump sum, the insurance company can also grant you a discount. You might also want to consider a direct writer. A direct writer is an insurance company that distributes its products to customers without the use of agents. Since they don't use agents, they don't have to pay salary or commission, therefore they can afford to offer you lower prices. You might also want to shop around. You want to compare costs among high quality insurers because it can save you up to as much as 25% for similar coverage. Lastly, you want to double check your policy. You want to ensure that the type and level of coverage and the endorsements that you requested are the ones that you have received.
Hey guys, my name is Mohamed and I'm going to be going over what to do in the event of a loss, as well as automobile insurance. So the key steps after an incident are: report the loss immediately, notify the police in cases of theft or vandalism, and inform your insurance provider right away. Protect your property. Make temporary repairs if possible to prevent further damages. Don't leave the property unsecured. Document the damage. Take detailed photos or videos of all the damages and list all items describing the items and their values. Keep all receipts and present everything to your insurance agent and the police. Communicate with your insurer. File a claim and keep a record of all communications with the insurance company. Confirm the adjuster's estimate. The insurance company will send an adjuster to evaluate the claim and recommend a dollar amount to the insurance company for the settlement. Do not agree to anything less than a fair settlement. So now we're going to go over automobile insurance, specifically personal automobile policy, PAP. So what is PAP? It's a standard automobile insurance for an individual or a family. Why do you need personal automobile insurance? So there are about 10 million automobile accidents per year, which makes up for 1 of every 15 licensed drivers. Almost every state requires by law that all licensed drivers be covered by auto insurance. Each policy contains both liability and property damage coverage, and each package of insurance contains 4 basic parts. So now we're going to go over the 4 basic parts of each package of insurance. The first one is liability coverage. If you're at fault in an accident, liability coverage helps you pay for the damages to others' vehicles caused by your automobile, as well as their medical expenses. It also includes payment for any court costs and legal defensive fees. Second one we have is medical expenses coverage. This coverage pays medical bills and funeral expenses, with limits per person for you and your passengers. Third one is uninsured motorist coverage. This coverage is required in many states, so if you're in an accident with someone who does not have car insurance, your policy may cover your bodily injury and property damage caused by the uninsured driver. And the fourth one is damage to your automobile, also known as collision and comprehensive insurance. It provides coverage for collision damages, as well as theft for your vehicle and for damages from almost any sort of hazard other than collision. So now we're going to go more in detail in the 4 main parts. The first one we got is liability coverage. Liability coverage consists of 2 things: split limit and combined single limit coverage by insurers. The split limit coverage provides separate limits for bodily injury per person, bodily injury per accident, and property damage. For example, $200,000 for bodily injury per person, $600,000 for bodily injury per accident, and $100,000 for property damage. The combined single limit coverage offers a single maximum limit that applies to both bodily injury and property damage combined. For example, $600,000 in total for everything. Now, for the flexibility and limits, split limits provides more detailed limits for different types of damage, while combined single limit offers simplicity but less flexibility. Medical expenses coverage. It's a coverage for medical and funeral expenses, includes reasonable expenses within 3 years of the accident for policyholders and family members, regardless of who is in fault. It covers accidents in or outside vehicles. It applies whether you're injured in an automobile, as a pedestrian, or even when not driving. The recommendation policy limits for this is a minimum of $50,000 of coverage per person. The third part is uninsured motorist protection coverage. This coverage is protection against uninsured drivers. It covers injuries caused by drivers without insurance or with insufficient coverage. It also covers hit-and-run accidents. It pays for injuries when the at-fault driver flees the scene of the accident. The recommended policy limits for this is $250,000 of coverage per person and $500,000 of coverage per accident. The fourth part of automobile insurance is damage to your automobile coverage, which is also known as collision and comprehensive physical damage coverage. So the collision coverage, it pays for damage to your vehicle from a collision, regardless of who caused the accident, and the comprehensive coverage covers non-collision related damage from theft, fire, weather, and other perils. The recommended policy limits for this is actual cash value of your automobile. In addition, you'll have to choose the highest deductible you can afford to pay out of pocket with a minimum of $500. So now let's go over the determinants of the cost of automobile insurance. First one is type of automobile. The sportier and the more high-powered your car is, the more your insurance will cost due to the risk and repair costs. Second one is use of your automobile. Less usage means lower premiums. Higher premiums apply if you use your car frequently, especially for business. The third one is where you live. Insurance is more expensive in urban areas due to high risks of theft and accidents. Discounts. Check for discounts you qualify for based on vehicle safety, features, and bundling policies. Insurance credit scores. Drivers with lower credit scores face higher premiums as they are seen as high risks by insurers. Personal characteristics. Young unmarried males typically pay higher rates due to statistically higher accident risks. Driver records and DUI. Past traffic violations, specifically DUIs, can increase premium significantly, sometimes over 60%. Now we're going to move on to filing a claim. Here are the steps to take after an accident. Ensure safety first. Help anyone injured and call for emergency services. It is a felony to leave the scene of an accident. Gather information. Get names, contact information, and witness statements. Write down the other driver's information if you had the chance to get it. Cooperate with authorities. Work with the police and insist on alcohol testing if you suspect intoxication of the other driver, and obtain a police report. And here are the final steps for filing a claim. Document the incident. Take photos of the accident scene and write down your recollection of events. This will help your insurer. Contact your insurer. File a claim as soon as possible. Provide all required documentation, including the police report. Track your expenses. Keep detailed record of all accident-related costs. This includes repairs, medical bills, and legal fees. In case of a serious accident, meet with a lawyer so that you know what your rights are and what you can do to protect them.